Our first question is, if all I wanted to do was make about $200 a day on average, approximately how much investment capital do you think I would need? My first problem with this question is it takes on the psychology of making money versus trying to make good trades. Remember, something we want to train our minds to think is that if we just make good trades and put ourselves in position to execute, then the money will take care of itself. It's a lot like sports, where you can't say I'm going to go out and score 20 points today in a basketball game, or I'm going to try and throw 3 touchdowns, because when you start forcing things, that's usually when it doesn't work. Instead, your goals have to come within the flow of the market. You have to say to yourself, I'm going to try and make 5 good trades a week. Okay? And if you can do that, the money's going to add up at the end of the week. And we talk about that in detail in our article about not trading to make money. Because if you're trading to make money, you're not going to make any. That's just the way it works. Okay? And the phrase we like to use is, don't trade to make money trading. And one of the tough aspects of trading is that disassociating successful trades with profits. Okay? Because there's trades I make that I believe are successful trades that I still lose money on. And that's because I don't let profits define my success. If I put myself in a good position and I analyze a chart and I identify the support and resistance and whatnot, and I have my target and I have my stop loss, and I go in and I put the trade on and I still lose money, that doesn't mean I made a bad trade. That just means I played a risk-reward scenario, and instead of reaping the rewards, I suffered from the risk. But we know that anytime we trade, there's a possibility of that happening. So we just have to put ourselves in good positions to make good trades. And at the end of the day, what will most likely happen is, if you're doing that, you'll have more gains than losses. As for what you need to be able to accomplish $200 a day, you need as little as $1,000, as much as $10,000 or more, depending on what type of strategy you're trying to implement. If you're buying and holding for 50% swings all the time, I don't know if that's a good strategy, but to make $200, you'd only need $400 then if you're going to make 50%, right? Or if you just want to make 2%, all you need is $10,000, and you can make that 2% really quickly, and that's $200. Not that that's a good strategy either, but part of trading is choosing your own strategies. So questions like this, I really think, they're red flags, because they tell me that you're more interested in making money every day more than you are making good trades every day. And until you can understand the difference between those two mindsets, what's going to happen is you'll likely struggle. Second question is in regards to option trades. And this person just wants to know what methods they should be using as far as getting in and out of getting in and out of options. And they use the example of Apple from today. And they say how they've been watching the strike price chart and the stock's regular price chart. They've been watching the level 2 price action on the stock and the level 2 price action on the option. And, what should they be focusing on? The level 2 action, a combination of everything, the option, the stock, etc. In my opinion, because we know the basic premise of an option, which is calls will rise if the stock goes up, and puts will rise if the stock goes down. That's the basic premise of options. Of course, there's time decay and premiums involved, which are important to understand. But for most of the options trading we're doing, unless you're going very, very far out of the money, if you guess the direction right, typically you'll stand to make money. Again, unless you're going far out of the money and you're paying a ton in premium, okay? Then that's different. But most people are probably not going too far out of the money because that's very, very risky, and we don't advise that except in certain cases. So what you should be watching, in my opinion, is just what you watch every day on a stock. You want to map out your supports and your resistances on the stock, because what you'll see is that if you have your supports and resistances mapped out on the stock, you will, and you trade based on that in the options pits, you'll typically make good trades. So for instance, here we had Apple, right? 15-minute chart we're looking at. I see Apple today opened up on incredibly high volume. The range in the first 15 minutes was 569.87 to 571.56 from the open to close. The overall range was 567.72 to 573.88. So first thing I noticed on Apple today, and I said this in the big board chat room at the time, was we had huge volume on Apple within the first 15 minutes and actually little price action within the range. Yes, it did gap higher. However, the actual price action that occurred was very minimal, suggesting that on huge volume, we maybe had a balance of supply and demand in this range. That was after we had bounced from 528 in just 2 days. So we had equilibrium down here, and it was on the demand side, as evidenced by this huge bounce. And now we have equilibrium up here, and it was safe to assume that it was coming on the supply side, since we had just rallied, 7% in Apple. So therefore, I get this range here, and right away I say, okay, once this is established, which it happens within the first 15 minutes, I say to myself, okay, if Apple breaks below the opening range, I'm going to short it. I'm going to buy puts. If it breaks above the opening range, I'm going to go long and buy calls. Now, let's look at those options on a chart. And I played today the 570s myself. I bought them around $8, I believe. Okay, so now if you look at this, let's look at a 15-minute chart of this option. So you can see, here's the first 15 minutes, and yes, it was around $8. You can see the range. And if we put it on the same page as our Apple chart, you can see that just like these stayed in a range, Apple stayed in a range. The reason I chose the 570s is because they were in the money, so I didn't want to pay a crazy amount in premium. And then you can see that as Apple broke below this opening range, this is when I initiated my short trade. So at the 10 o'clock mark, so that was in the 795 to 820 range was when I started buying. And you could see throughout the day, then after Apple broke down, now what do I want to see? After a breakdown, we always want to see that level then act as resistance on any bounce. You can see this level did exactly that pretty perfectly. So we would have stayed in this trade. Our next support level really wasn't until here. You can see the support level we got, okay? Then we bounced right here, so then we have this support level that got established, if only for a few moments. So you can see, we bounced, that becomes support level, we broke below it, tested this support level, then this previous level of support acted as resistance again, and then once it broke below yesterday's close and went red, it just really tumbled all the way into the close. And you can see these options went from $8 up to as high as $18.50, so over 100%. So my point is yes, you could have traded the option based on this chart and done relatively the same things. Identified the tight range, seen that it was breaking out and trending, and then, once it broke this level here at $12, it really made a nice move all the way up to $18.50. However, to me, it's much easier to just trade the stock itself, to just analyze the stock itself and then go into the option and trade it that way. Here's a good question. So I'm always talking about how you need to be watching the VIX and oil, which is USO, in relation to the S&P 500 and using them to gauge market conditions. So this person's asking me to elaborate the relationship they have with the intraday market or the general market, and how do I use them to gauge the market? Well, first of all, what's very clear, as I'm going to point out, USO and SPY have a correlation. USO tends to lead SPY, meaning it peaks and bottoms before SPY does. VIX and SPY have an inverse correlation, an extremely accurate one as well. So let's analyze. This is going to be clear as day to see. So here we have a 100-day chart of SPY, which is the ETF that represents the S&P 500. And here you have the VIX. Just a beautiful correlation, inverse correlation. You can see that as SPY rises to new highs, VIX falls to new lows. Okay, and as VIX rises to new highs, the SPY falls to new lows. If you go back and you look at a weekly chart, you can see this very dramatically over the last 3 years, over the last 5 years. Okay, really since the VIX's inception, you've had this. So that's why I like using the VIX to gauge the market, because when it starts to creep up, the VIX, like it's doing here, that's typically been a bad sign for the market and led to a broader pullback. However, when the VIX really goes crazy and gets up here around 40, that tends to mark bottoms in the market overall. Okay, so basically when the VIX is extremely low, say below 16, you want to be cautious, because that has tended to mark tops for the market over the last 4 years. Vice versa, when the VIX gets extremely high, say above 40, that's tended to mark bottoms in the market. You can see here In 2010, we had the VIX, below 16. Next week, the market ended up peaking. Then the VIX ran up to 40, and that was pretty much the bottom for the market then. Again, you saw the VIX make a move up near past 30. Looked like it might have hit 40. And then that was also a bottom for the market in early 2011. Then later those next few weeks, though, in April, the VIX was below 16, bottoming out, and the market coincidentally was above 136 or 1360, topping out. Then in August, September, you had the VIX skyrocket up past 40, and it turns out as that was when the market was going through a bottoming process. Now, more recently, again, you had the VIX below 16, S&P above 1400, and that was a top. Okay? And if you look at an intraday chart, you see this correlation very, very perfectly. When the market was going on highs today, the VIX was at its lows for the day. Okay? One of the things that cued me off to short the market when it started bouncing was this action right here. So the market pulled back from highs, found support. We're looking at a 5-minute chart, by the way. Pulled back, started bouncing again, tried to break back above that 133 level, but notice the VIX was not breaking to its lows. Okay? Because the VIX was not breaking to its lows, that told me that the market isn't likely to break out and retest these highs. Because remember, the inverse correlation is such that when the market is going to break to new highs, the VIX is going to be on the verge of breaking to new lows. That didn't happen. Then again, you got another great signal. The VIX actually put in a higher low late afternoon versus this low here. Okay, SPY tried to retest these highs. So that was another great short signal. And then look, into the close, the last hour of the day, VIX really went on a run. What happened to SPY? Just absolute tank. Okay. And if you look at a 60-minute chart, you can see that this correlation is extremely accurate and very helpful in guiding your trades. And as for USO and SPY, here you can see the correlation. You can see how they follow each other on the 60-minute chart. Now, what I really want to point out on USO and on oil in general is its tendency to peak before the market peaks, and its tendency to bottom before the market bottoms. So here we have USO, okay? We've got, if we just look at a weekly chart of USO over the last 3 years. So we saw that it peaked, last week in April of 2011. Well, SPY ended up peaking the next week. We also see that USO started to peak the last week in March, first week in April in 2010. You can then see that the S&P peaked, the following weeks, 2 weeks later. It also peaked. Now let's look at the bottoms. You can see in 2010, USO bottomed around the 3rd week in May, and then put in a higher low against that bottom, and then, broke out. SPY, meanwhile, didn't bottom until June 28th. But notice while SPY was breaking below its previous lows, which might have caused some to be bearish because it was a lower low during that week of June 28th, USO was actually putting in a higher low versus this low here. So USO was telling you to buy this bottom, that this was actually a head fake, okay? And then again, you had another low here for for SPY, August 23rd. But if you look at USO, again, it was a higher low versus that overall bottom. So you got another signal there. Now in October of this past fall, the SPY bottomed, and USO, that was an occurrence when they actually bottomed at the same time. But if you look here in February, last week in February, USO topped out. Oil topped out again. You can see that the S&P 500 continued higher, but this week here, April 30th, when it tried to retest these highs, you can see that USO was actually breaking down. Sorry, USO was actually not even getting back above the prior base of $40. So USO is telling you that this move here in SPY wasn't very convincing. So the way I'll use USO and the VIX to guide me now is, number one, in regards to the VIX, if I see it really start to skyrocket, instead of getting scared, I'm going to look for buying opportunities, because recent history suggests that when the VIX does get extremely elevated, that's actually when you want to be buying, okay? Most people end up selling when the VIX goes very high because they say, oh, the VIX is so high that signifies panic. No, it signifies a market that's already panicked, okay? Remember, the VIX is an instrument that measures the put-to-call ratio on the S&P 500 for 30 days out, meaning that if one put is bought for every one call that is bought, the ratio is 1. Okay? If two calls are bought for every one put that is bought, the ratio will be 0.5. If 1.5, if it's 2 to 1 in favor of puts, then that'll be your ratio, and so on and so forth. So remember, when you see the VIX start to move higher, what that means is that more people are buying puts, or I shouldn't say people, more put contracts are being purchased on the S&P 500 for the next 30 days than call contracts. Why do you purchase put contracts? Presumably because you believe the market is going to go down. However, what you have to understand is that big institutions and hedge funds might purchase put contracts on the S&P 500 to hedge against stocks falling, okay? If you're a giant hedge fund and the market is crashing, your job is to put some money to work. That's what you do. You don't collect huge fees because you tell your clients, oh, I'm keeping my money in cash. No, that's not what you do. Clients pay hedge funds and big institutions top dollar to figure them out a way to make money even when the markets are crashing. And the way they do that is by going bargain hunting and buying stocks and picking up stocks on the low, and then using something like the VIX to hedge those positions. So remember, when the VIX gets extremely elevated, it isn't a sign of a market that's panicking. It's a sign of a market that is already panicked. This is very important to remember. And when the VIX is very, very low, it's a sign of a market that might be getting ready to panic, right? Because if everybody's buying, if everybody doesn't expect the VIX to rise or go lower, that's when you want to be expecting those things to happen. And as for USO, what I'm looking for is I want to see where USO is going to bottom, okay, maybe around this $34 range here. And then I want to see some type of base in USO, okay? And along with that base, then what I would watch, I would want to see if SPY breaks lower by itself, meaning it continues to trade lower, but USO actually stabilizes and doesn't move lower. Because remember, since USO tends to bottom out first, that would be a sign that stocks are actually close to a bottom. Now, if SPY goes lower and USO goes lower as well, then you'd have to be cautious and you would have to respect what oil is telling you, and I wouldn't necessarily start buying stocks. Or maybe SPY will go higher right now, like it did today initially, but USO will actually move lower, and that will tell me to short stocks. For instance, you can see today versus yesterday, USO actually gapped down. And the reason I was shorting stocks all day today is because USO gapped down and SPY tried to rally here, but USO wasn't able to rally. You can see here, here's when USO really broke down, right around 11:35. 11:35 to 11:50 is when USO really broke down, okay, and really gave up those attempted gains. And then it muddled along and SPY consolidated, and then it tried to bounce up, right? Tried to bounce up, wasn't able to, so SPY wasn't able to either, coincidentally enough. And then USO broke even to newer lows, and finally the action in USO, by coincidence or not, seemed to have catch up to the action in SPY. Now, we don't know 100% why this is going on. We just know that it is going on, and recent history of the last few years suggests that we should keep paying attention to it, because on days like today, it is very, very reliable for helping you determine which way you should be trading. Just like yesterday, just like you have here over the last 3 days, you can see USO tried to bounce and then fell lower, but then bounced again and showed those signs of a gain. So right here, this action, I knew that USO was trying to bounce. It was finally showing signs of wanting to bounce, so I knew that a bounce might be close by. Sure enough, in SPY, we had that nice bounce yesterday. So those types of indicators can really, really help you. Okay, this question, last one in regards to level 2. I know that you stress looking for bids to stack in favor of the bid and for the ask to thin out is being bullish. The question is it more valuable for there to be more MM stacked or to have a greater value on the size of shares with less MM stacked for the overall bid prices? I would say it's more valuable to have more shares on the bid versus having more MM stacked. Because quite simply, we're concerned with supply and demand, and we want to see as much demand as possible. Ideally, there's going to be a lot of MMs on the bid, and the bids are going to be a good size. But if you could have 5 MMs on the bid with 5,000 shares each versus 2 MMs on the bid with 25,000 shares each, I would rather have the latter, because I'm concerned with more demand more than anything else. That's what I want to see on the bid. I want to see demand. And then in regards to volume, it's a good question as far as what's the best way when we see a volume spike that is worthy of consideration for making a buy without waiting for more volume bars for confirmation. Sometimes during more volume, the price moves a lot, sometimes a little, sometimes not at all. Many times if I wait for more volume bars for confirmation that it is going to move up, I have found that I missed the entry price. On the other hand, I have found that if I jump in without the confirmation of more volume, then I have found myself buying too high and needing to cut losses. Well, remember, you can have volume spikes, but you always have to be comparing them to the most recent price action. Are they volume spikes of 1 million shares or 2 million shares when the stock just traded 10 million shares the day before? Because if that's the case, then that's not, a very legitimate volume spike. But if it's a volume spike out of nowhere and the price is increasing, then that's something that you could maybe jump in on more quickly. For instance, CQPT today was a stock that had a volume spike on my scanner out of nowhere. You can see today's volume, completely trumps anything else it's ever done. I noticed it on this volume spike, but what I noticed is the price was decreasing. It was actually falling down, and I was watching level 2. There wasn't much bid support, so I waited. Then, here though, we had a lot more volume, and it was much more consistent, and the price was staying the same, so I was able to wait. Then towards the end of the day, it finally started to pop a little bit. Okay? Then on AECP, which was different, I had the same volume spike, but right away I noticed the price was increasing on the volume spike. So I bought right away, and I ended up selling 2 minutes later for a nice little gain. HYII, look at this volume spike right at the open. Compare it to the prior day's volume, absolutely nothing. So I bought right away, and I also sold it, from 80 cents up to 88 cents. That's a nice quick gain. But then notice the volume became much more sporadic and inconsistent throughout the day. So when I saw volume spikes like this or like this, I didn't necessarily want to jump in as much because, number one, it wasn't right at the beginning of the day. This volume compared to the previous volume earlier in the day wasn't that significant to me. And the price had fallen. It wasn't increasing like it was here. GWBU. We haven't really had any volume spikes, so we can't really cite any examples. But again, though, the best way to handle something like this is going to be preparation. Okay? Because these stocks that I just listed, AECP, HYII, and CQPT, these were all stocks that hit my scanner that because of my experience, I was just able to jump in right away and I know what I'm looking for and how I'm going to trade it. But the best way to deal with a problem like this if you don't have as much experience is to prepare the night before and come up with that watch list so that way you already know what you're looking for out of the volume, so that way when it presents itself, you're ready to take advantage like that with the snap of a finger, and you don't have to think about it as much, and you don't have to wait for other types of confirmation. Okay? Preparing and preparation, i.e. putting together a few stocks to watch the night before, and then executing is what's going to avoid this problem. Looking at a chart of DNAD, so what I notice is it's in a terrible downtrend and it's really diluted, and even worse, there's volume that has traded in the past. So while the volume is at all-time highs right now over the last month and a half, there's a lot of bag holders here from this volume back here in 2011. Highest volume on an update today in a couple weeks, that's good, but it's still only 34 million shares, so, $90,000 or so. So not a lot of liquidity for us to play around in. Gave up 100% of these gains, so it has a history of giving up gains on more than one occasion. Needs to break 004 and stay above it. And I'd like to see volume pick up. Unless it can break that 004 level and stay above it, it just doesn't really interest me too much. JPM, so, obvious nasty downtrend here, but we finally started to bounce. So this level is key. Yesterday's low at 32.26. That's the key level to watch. Got above yesterday's high, got above Friday's high. Good signs right there. Gonna have a lot of resistance here though between Thursday's high of 35.10 and Wednesday's low of 35.46. And that's if it can get above today's high, 34.58. This is a problem right here from May 11th because anybody who bought shares on that day, which it was the most volume the stock had ever traded in its history, they're now holding a bag. They're bag holding. So this whole range is going to be problematic if the stock can find its way back up there. Because remember, all of these people are bag holding now. They're all sitting on losses, so as the stock gets closer to them, you're going to have a good portion of those people who are just going to say, screw this, just get me out at break even or at a minimal loss. Okay? And that's also why yesterday's low is so important, because anybody who bought yesterday is up today. So now if it goes back below yesterday's low, now anybody who bought today is looking at a loss, and you know, they're going to be thinking, dang, this thing still hasn't bottomed, just get me the hell out. Okay? Now, from a longer term perspective, this is the key level, is these 2011 lows at 27.85 on JPM, that 27.85 to $30 level. The volume is on track to be the highest volume on a down month in the stock's history, in the stock since June 2009. It's also on track for its 2 consecutive down months. That'll be the first time since this stretch here in 2011. It's going to be the highest volume on a down week last week in the stock since, again, June 2009. The difference between June 2009 and this time is that in June 2009, it did that volume coming off of a bottom. This time it's doing that volume coming off of a top. So you can see in June 2009, it didn't necessarily kill the stock that much. It only declined from 33 down to 32, 35 down to 32. Whereas this time it's coming from a top. What I mean by that is the high recently was 45, okay, versus here it was coming off of a major bottom at 15. Now, longer term, I see a couple things. Failed at these highs. Failed to hold its 2010 lows. Failed to break above its 2011 highs. So now, like I said, this 27.85, the 2011 lows are key. If I had to guess, I wouldn't be surprised if JPM broke its 2011 lows, just because right now the pattern is for lower highs and lower lows. However, overall, it's still above the key, 2009 lows. And really, you've got this huge range on the stock from that bottom. Which was a range of 1502 to 2433. I wouldn't be surprised if it found its next bottom between $24 and $25, $26. I think you've got to respect the volume and the price action. Longer term, a stock like JPM will probably recover and be fine. You can see that this low, it has kind of this double bottom working for it here. And maybe on a much longer time horizon, what I see is it gave up all of these gains, got a good majority of them back, gave them up again, got a good majority of them back, gave some of them up again, and got a good majority of them back. Okay? So it's been tradable in both directions. You can see the downtrend here, though. It's just caught in a long-term downtrend from these highs that I put in at 2000. Let's look at the 15-minute chart, see where a lot of the demand is hanging out. So a nice spike at the end of the day. So this low is important at 33.75. That's a nice even low. So you want to see it stay above 33.75. If it doesn't, the next level would be the open of 33.33 from today. Below that, it kind of opens up to the base of the gap at 32.40, 32.50, I'm sorry. As for resistance, had a lot of supply come out from 34.40. So needs to break above 34.40 again to potentially test that 35.10 to 35.50 range we talked about. Okay, GWBU, obviously the big promotion stock right now. So had the big run up, right? Massive volume, started around 76 cents and took it all the way up to 160, pretty much uninterrupted. And you had a lot of volume trade here in this 142 to 165 range and couldn't really extend past 160. Kept having trouble with it. And then yesterday was the huge dip. If you look, you can see that it fell on just massive volume, but look at this bounce. I mean, just a sick bounce from 111 all the way and closed at 158. So the thing that's interesting about that is it seemed very manipulated because you have the close here at 109. It seemed like maybe they wanted to fill that gap or didn't care to support it until it filled the gap. Now, it did pull back again today, but the volume was way lower. So that's a good sign because it showed that even after this huge shakeout yesterday, after something like that, you might expect people to be very nervous and you might expect supply to pick up at current levels. However, that wasn't the case. Just a modest 4% down day on the lowest volume it's traded since, the heavy volume started trading. So what we want to watch, though, is it did start selling off into the close. So you want to watch, see if that carries over to tomorrow. See if today's low of 148, that's going to be the first support. And then below 148, you've got, this kind of looks like a fat finger low to me. You've got this low at 146, and then these lows here right around 140. So really, the 140 to 148 range is really key support because then below that, that's when you could have another big dip. You wouldn't have any support below that. You'd have this low at 137, but then like the 5-minute chart shows, you wouldn't have any support until some of this buying here in this 110 to 125-ish range. So key support first at 148, that's today's low, and then in that 140, just north of 140, would like to see it hold there. All in all, until the chart shows the ability to move lower, we have to assume it's going to keep showing the ability to do what it has already done, and that's move higher, okay? It's like a horse that keeps winning you a race. Until it loses you the race, why are you not going to keep betting with it? GWBU has been very strong. It's held on to, 300% gains since it first started trading. So there's certainly a lot of support, even at these levels. Yesterday's bounce from 111 all the way to 158 tells you that there's some serious support behind the stock. And so, if it can keep consolidating up here and then eventually break 160, it would not surprise me at all to see this thing hit $2, and then, we'll talk about it again then and see what's going on. if you want to know when the up move is going to happen, if you take a look at this, this was on Tuesday of last week. And if you take a look, that's the last time it made a real big move at the open. And that came on 2.7 million shares as the price was increasing. You can see not since that time has it had such good price action and volume at the open. So if you see within the first 15 minutes that GWBU trades 2.7 million shares and it's able to move 5 to 10 cents, that could be your sign that it's getting ready to break 160. BPAX. This is a chart we've been following for a long time and recommending people stay away from for a long time. The reason is because of this nasty gap down on major volume. We just don't like that. Gives up all of its gains. Just even when it goes up on high volume, it gives up all those gains. Just too much resistance going on here. Nothing to really like. No real favorable risk-reward factor here. Okay, from looking at the 5-minute chart, you can already see that, again, today it gave up all of its gains. So it rose from 46 up to 60 and then gave it all up on very low volume and closed at 46. So this is the key low, is going to be 45.34 from this morning. Below that, I'd expect a retest of this low here at 43 and, yesterday's low. As for resistance, it struggled with the 51-cent level in the afternoon. So needs to get back above that. And then this level here at 54 cents, which provided support in the morning, I now expect it to be resistance. So 51, then 54, and then you have this high here at 59. But again, from a broader perspective, we want to focus on charts that offer uptrends. And this stock just doesn't look appealing. The reason we want to focus on stocks that are in broader uptrends is because uptrends tell us there is a recent history of demand favoring supply. And what causes prices to rise is more demand than supply. And we make money when we're in a stock and it rises when we're playing from the long side. So therefore, why do we want to try and make money on the long side on a stock whose recent history suggests a pattern of more supply than demand? It just doesn't make sense to me from a risk-reward perspective. I would rather play a stock like GWBU where the recent history suggests more demand than supply. FMNL. Very nice uptrend. Huge move from 45 cents. Hit 90, so you had some psychological resistance because that's the 100% mark, right, for those people who got in at 45. What I don't like here is the price is increasing on lower volume, lower and lower volume. So that's kind of caution sign because, remember, we want as much demand as possible. And if you break it down into the 15-minute chart, looks like you had a block trade here for 300,000 shares. So let's wash that out. Let's get a 5-minute one-day chart. Oh, well, that was yesterday. All right, so first thing I noticed is the volume is kind of inconsistent throughout the day. It doesn't stay, it comes and goes, and then it goes through some periods of inactivity. And especially in the afternoon, it was really, really dead. So you got to be aware of that. While it isn't an uptrend, if you're going to be in this stock, you might be looking at paint dry for a little bit. So if you like action and you know you're not a trader who likes to be patient, then this isn't a good stock for you and you should just avoid it. If you're somebody who doesn't like the crazy volatile swings that a stock like GWBU offers, then this is a good stock for you because you know that you can just not really have to be watching it 100% of the time because it's not necessarily going to be moving all the time and trading all this volume. Now, strictly from support and resistance, we have really wide ranges. So that kind of makes it hard. However, we do have this spike here on the 5-minute chart. Highest volume spike of the day. So this is going to be our support channel. Why? Because that's where the most demand was in a 5-minute basis. So we want to see where demand was we want to see demand still exist where it once was. So tomorrow, this is the range I want to see hold on any pullbacks, that 78.5 to 84 cent range. Okay? As for resistance, you've got today's high of 95 cents and then $1. I would really prefer to see volume start increasing. If we're going to break a buck, I'd like to see it happen on greater than 500,000 shares. And it appears my chart just corrected and it actually did trade more shares today than yesterday. So that's good. Let's just double check that. And now it's going back again. All right, what's going on? Let's check stockcharts.com very quickly. Because this is important, if it increased on lower volume or greater volume. So it was the same amount of volume, and it actually closed near the high of the day. So this chart that I'm looking at is a bit misleading. But resistance is still going to be 95 cents and then $1. So this volume pattern is much better than the one my chart was suggesting, so that's good. And of course now it corrects back to the right chart. So that's a good sign. I take back what I said about it not increasing on greater volume because we do have greater volume. And the reason that's important is because, remember, previous demand is always going to become future supply at some point. Meaning that if somebody buys shares at 50 cents or 60 cents, at that moment they are demand. At that price, they are demanding shares, and they get them. But at $1.95, they are now going to be looking to take profits. You have to assume, right? So now that previous demand is going to be future supply at 90, 95, $1, somewhere around there. You have to expect that, logically. So therefore, that's why you need higher volume as the price is increasing, because you need to see enough demand coming in to take care of what is going to be new supply. Because these volume days here, we need to see them get wiped out in order for the price to keep increasing. Or they'll need to hold shares, which if they keep holding after a 100% gain, they're just being greedy and the stock is going to have a big, big pullback. Because now not only will these people who didn't sell at 100% gain, well, they need to sell later, but now everybody who bought today, they're going to have to sell later, and it's just going to be a snowball effect. So that's why you always want as much volume as possible as the price is rising. I'll save QQQ for last, since that's the overall market. So AECP, one that popped up on our radar today for unusual activity, 1 million shares traded. And what I like about charts like this is it pops out of nowhere. The volume is very suspicious, and we have to wonder, who is doing all this buying? Is it going to be promoted? What's going on here? Who knows what we don't, that they're willing to buy all these shares? Now, the key is, if this is real volume, i.e. not wash trading, okay, so if it's organic volume, we're going to see the price hold above where all this volume traded. Well, it first started to trickle in at 26 cents or so, okay? So you want to see today's low of 25.5 really hold. And if it doesn't hold, you want to see it go below that price on extremely low volume, okay? A good example when guessing these promotions is a stock like RARS, which had huge volume, but then the next day gave up all of those gains from that volume spike and went below where the majority of that volume came in. So that was a red flag. Okay, and then you can see what happened following that. Trying to think of some other off the top of my head. HPCS has always been one that people have suspected would be promoed. And you can see the volume pattern. It's always ended up burning people for guessing. Okay? But sometimes, like on GWBU, which we noticed on this day, when the volume came out of nowhere and it traded at 40 cents and we bought shares? Well, guess what? We caught it before a major promotion. So that's the risk and reward that you take with a stock like AECP. And the way to minimize your risk is you want to see it hold the levels at which the volume traded at. So that's what we're watching for most in the days to come. Also, if it's going to continue rising, you want to see it do so on strong volume, okay? A good example of a stock we found out of nowhere, XRMB. We found this when it was right around 24 cents or so, and you can see it started trading volume out of nowhere, and it's gone on to just make a stealth move all the way up to 60 cents. So again, just understand what you're getting yourself into. For every GWBU that we find, there's an RARS. Okay? So you got to be aware of that, and you got to understand the risk you're taking. QQQ. So wasn't a very nice uptrend. This is a 100-day chart. Broke this uptrend here that it had been on. And you can see that's when it really started to struggle. If you take this breakdown on this day, the high was 67.44, and you mark it as a resistance line, look how perfectly that this level acted as resistance after this breakdown. Coincidental or not, it is what it is. So the range from this breakdown really capped any rallies moving forward after it occurred. And then you can see once it broke below it the second time and tested these lows, you can see how this prior support level acted as resistance. And then if you just go down the line, you take this prior support level from the March 6th low, you can see it broke below it, and then that level acted as resistance today. So what we have is we have prior support levels being broken and then turning into resistance levels. That's very bearish overall. Okay? This is in the short term we're speaking. It's falling on very high volume, and it went up yesterday on low volume. A positive note in the immediate term is that while it did give up all of its gains today, it did not give up all of its gains from yesterday. Furthermore, it did find support at Friday's high. Today's low of 61.99 is right near Friday's high of 61.96. So maybe you have in the immediate term Friday's resistance becoming support. However, that will be negated if it falls much below this level. So the 61.79 to 61.96 range is really key for me on QQQ. Below that, I would expect a retest of this low. Let's take a look at the longer term picture here to put things in perspective. So QQQ is testing a key uptrend line that it's tested a few times over the last few years. So you can see there's this really nice channel that's been going on. However, the problem is it's getting closer and closer to breaking to the downside and farther from breaking to the upside. Now, below this support line, you do have other supports. You're still in an uptrend. You can always find uptrends and downtrends on a chart. It's just a matter of over what time frame are you focused on. For instance, if you take this trend line here, connect the 2010 lows with the 2011 lows, QQQ could fall all the way to 55-ish. Let's see where it'll be moving forward. So 55-ish to 57. Come July, it'll be, by July it'll be 57. June, it's going to be around 56. Next week, it's going to be around 55, 60. Come August, September, it'll be around 58. So QQQ could still fall a ways and still remain in this uptrend off of these lows from 2010 and 2011. Okay? And you can see the congestion on that trend line between 2008 and 2009 as well. So it does hold significance. Now, we also have something else interesting going on here that would be very bullish. So we have these highs, which was resistance on QQQ. Finally broke above it, right? Now, what would be very bullish in my opinion is if QQQ finds support above or right around these highs. That's going to be around 58, I believe. Yeah, 58 to 59.50 or so. The exact high was 59.83. On the low high, it was about 58, 59.04, 58.48. So if QQQ can find support in the 58 to 60 range, basically, more specifically 58.50 to 59.50, then it'll be holding these prior highs. So while in the immediate term, we're seeing QQQ turn previous support levels into resistance levels, in the longer term, we could actually see QQQ turn a significant resistance level into a support level, and that would have very bullish implications. Furthermore, QQQ broke out to 10-year highs. That's very bullish in my opinion. So it's showing you the ability to move to new highs. It's still well off of its all-time lows, highs. And what's interesting is you can see QQQ fell short. So this was the tech bubble. This was the burst of the tech bubble. QQQ, what a sick move from 48 up to 121 or so. That brings me to another point. People talking about a tech bubble. Facebook, Apple, Priceline, Amazon, LinkedIn. Everybody wants to throw out the word tech bubble, right? I mean, maybe we are, maybe we aren't. But if we were, I would suspect QQQ would be much, much higher based on what it did in the past. So back focusing on the immediate term, since we're traders and we're typically short-term traders. So here's what I like. Here's what I don't like. Gave up all of its gains for the day, closed near the lows. However, the last 10 minutes of the day, very nice bounce from 62 all the way back up to 62.41. In addition, prior high right here and some lows right here. This is a 5-minute chart of the last 2 days. That's exactly where it found support. So I like that. A level at which a level of previous resistance turned into support, and then it held again as support. In the last 5 minutes, the price action was great. The volume was great. Very high volume into the close as the price was rising, so that's good. Came off the bottom. Showed that ability. So now this low is very important. This 61.99, just call it 62. Below 62, you have this high 61.84, which is right in line with that 61.79 level we talked about as the prior range of Friday's open to high. Below that, you'd have this low here of 61.63. Below 61.63 could really have a retest of that low. So, in summary with QQQ, Short term, it's in a downtrend and it needs to prove itself, needs to break some levels, needs to reclaim this $63 level here. More longer term though, very, very healthy, broke above these highs. You want to see if it can turn those highs, previous highs, into new support.